It's time to introduce the next speaker of the LYD25 Unstoppable Growth Conference, the Guru himself. Please give a warm welcome to Director of Lightyear Training Group and Chairman of SAPEPPA, Grant Abbott.
Okay, so I've got to do 10 strategies in half an hour. So the first thing you've got to do is take a deep breath in and make sure that you allow everything that I'm going into your unconscious mind. So just let me program it. So it'll all come back for you. So we went through a lot of this stuff yesterday. I know some of the people at the back can't see the board, so I'm going to explain exactly what it is spatially. So we're going to do a lot of that one. As you can see there, now that you've probably heard enough over the last couple of days, I want you to take away from this today is that intelligence is nothing anymore. It's virtually cents in the dollar. You can go in and go to deep research, do like a PhD paper. Like you can feel as though you're like, the most intelligent person in the world. But again, one of the things that will come back from AI is how you direct it. So it needs to be within your field. And you'll see with that tax guru, like I could ask a tax question of ChatGPT or even the top one, and a lot of it comes back for rubbish because what it does is it goes out to the web and then it pulls in all the rubbish. So if you can think of all the rubbish, and if you can think of all the AI robots that are just putting more rubbish out there, all you do is you get a lot more rubbish. So what we've done with Tax Guru and a couple other ones is you build an agent. I've got 40 different agents. I've got one, happy to give it to you. I don't know why I built it, but it enables you to ask any question around Australian accounting standards. Now, why I built that, I don't know why I did that, but I am doing one around SMSF audits. So I'm building a special tool where you'll be able to ask any audit questions. So all it does is the agent you build just has those documents there. So you can ask questions of those documents because I know they are the truth. Does everyone follow me on that one? So if I can get the truth and get it verified, then when I'm asking it or when I'm producing reports from it or producing materials from it, I know that it's going to be truth and verifiable. So again, the key is the strategy. So how are we going to use AI or how are we going to use strategies? So a lot of the strategies I always test with AI, it's always going to be, I have a farm in a client's got a farm in New South Wales. They've got $1 million sitting in their self-managed superannuation fund. They want to transfer it into the superannuation fund. They're 63 years of age. They're a farmer. And then what they want to do is they want to then pass that farm on to their eldest son. So when you go through that process, it comes back with a semi-reasonable answer. Probably I would rate it maybe a 4 out of 10 because in that one little prompt that I've given or that one case, there's around about 20 or 30 different issues. Like how are you going to pass it to the son? In New South Wales, you've got the concept of notional estate, which actually allows them to look through the self-managed super fund if someone else makes a family provision claim. Now, I'm not going to, at one stage it's going to get there. But again, I prefer Grant's model of the world because I sort of know that's my field. So what we've got to do is focus in on strategy, and I want to make sure that we go through a lot of strategies for you. So these are my top 10 fast strategies. So does everyone feel like this? Is everything just moving so quickly at the moment? I mean, gosh, it's Friday is Valentine's Day. And I've even thought about cards or whatever. So I had an embarrassing position the other day. Again, I've got ADHD and I don't mind saying that, which allows me to multitask. But at the end of the day, I'm just doing I'm doing like 3 or 4 jobs at the same time, which is great for me. But my daughter called up and said, oh yeah, we've just been to, because she just got engaged. Oh, we've just been to this wedding centre and all of that sort of stuff. And then I thought, holy shit, it's her birthday today. And this was like in the afternoon. I said, oh, yeah, I was going to give you a call tonight. So, again, time is just slipping fast. I mean, she's 27 years of age, and some of you have been around with me, for a long time. You probably remember when she was just like a little tacker like that. So it's going so quickly, and it's important for us to move as quickly as we've got. So leverage all of these tools that you've got. Okay, so my top 10 strategies. The first one, I'm going to say, look, if you want to get to family wealth protection, first one, buy the book. I should have had like millions of dollars of books, but the bloody have to get the Lightyear guys to actually fork out some money. So do the SAPEPPA course. So that's a 2.5-day course, a 3-day course. So we're working out whether we're going to have it here or the Gold Coast. It starts on the 31st of March. So if you're on those mentor programs, you get it included as well. So that will give you your aha moment. The second one, which is really important and I believe is the best for us, is the Board of Guardians. So we went through all the mentoring. The Board of Guardians is really important because, for example, if something happens to me, I've got SMSFs, I've got discretionary trusts, but my wife is absolutely beautiful, but she's artistic. Well, there's nothing wrong with that. And from that perspective, she's not going to be able to handle what's going on. Plus, I've got children from a different marriage. Now, there's no conflict at the moment, but we want to put a guardian in there. If you've got parents, so the first thing is, so a lot of you got young, how many people got kids under the age of 18? Okay, so who's the guardian if you both die, both parents die? Is that an important question? Absolutely. And if you've got kids who have got autism, ADHD, what are you going to do? I mean, you need to have these thoughts. And that's why if you come through that guardianship, what I do is I give you an AI tool that allows you to make ethical decisions. And look, I think it's brilliant personally, but I must admit I stole the idea off law course. So you want to do the SAPEPPA course, the SMSF. So I haven't done one of those for the last couple of years. How many people do SMSFs? Okay, so it'll probably be, I think it's around about May, I'm going to do a 3-day course and all it is going to be is strategies. So it's going to be, at the same time I'm going to launch a new book, which is my top 50 SMSF strategies. So you want to come along to that because I'm just going to blow you away with what is possible and that's really important. AI, Board of Guardians, anyway, let's go down the track. Okay, so the first one, this is going from the top down. What I would suggest is that you can all, if you want, you've got two reasons. So you can all go in and should all have the Lightyear Docs SMSF trustee. It allows an SMSF will. It allows cryptocurrency. It allows, I mean, here's one thing. If I've got a dad on the pension side and I've got a son on the accumulation side, is everyone with me on that one? So I've got two members in a fund. Dad, pension side, son, accumulation. Has everyone got that one? Here's the question. Can dad's pension lend money to the son to buy crypto inside that fund? So let me go through that. Has everyone got that one? Because I want to really twist your brain over the next 30 minutes. Can dad's pension fund lend money to his son's accumulation fund in order to buy cryptocurrency? What do you think? There's one source of information for it because it's all within the fund. So we're not borrowing. So the SIS Act doesn't cover it. We've obviously got to make sure it meets the sole purpose test, but gosh, it is because dad's getting interest income, which he needs, and the kid's getting capital growth, which they want to maximise their retirement. Does that follow? But the constituent set of documents, the laws, are your deed. Does the deed allow it? Like if you want to use one of our SMSF wills, which I think are brilliant, I'm going to talk about it very shortly, you can't use a standard someone else's deed because they're still old school using binding death benefit nominations. And you would have seen in our AI assistant, I asked it, you know, why is an SMSF will better than a BDBN? And it came out with 3 pages. And if read the pages, I don't care, you listen to me, have a read of what's actually going on. So you want to make sure that you upgrade all your SMSF deeds to my latest Lightyear Docs deed. Now, for you, you can go online. So for me, it's not really bending over where it's a legal service. All you have to do is go in, find what the upgrade clause is under the old deed, and then put that in the relevant place. Honestly, it takes 2 minutes, and then it'll basically do it for you. If you don't want to do that, and you should be charging, I would have thought $750 for that. If you don't want to do that, then send it to LY Legal or LBO. We'll do it for $295, and then you can still charge $750. So all you need to do is just send us in the deed, and then we'll go through the process for that. So that's the first one. If you want a letter, you can either do it through the AI assistant or contact Atira. Do you want to stand up? So Atira's here through LBO. So if some of you asked me about LBO, and some of you said I'd try to contact Tony. Why would you do that? You never contact Tony. Contact Atira or Nush, which you've seen up on the thing. So thanks for that, Atira. So contact them if you want to make an appointment with me or set something up for me or want to do something like that. Does everyone follow that one? So that's like my worst strategy. Upgrade it all. If you've got, how many people got like 50 or more self-managed super funds? Okay, so there's some easy money there for you. But it's not easy money, it's all about compliance for that one. And again, if you see any other strategies that might be wild and wacky, send them through to me, and I'm going to put it through my clone of Grant Abbott to actually find out what it is going to do. Okay, so this is one I've talked about a lot. So what we can do here is we've got our self-managed superannuation fund. So you don't try and do this with a retail or industry fund because they just don't know about it. So what I'm going to do is the caps at the moment are $30,000. So this is fantastic for your PAYG. I'm going to give you a few layers on this one. So for a pay-as-you-go, most people around about 35 to 45, when we had a look, remember when Clayton was going through that Moore's graph, you know, the early adopters and all of that sort of stuff. I did probably about 15 years ago, I used that model to say, in terms of self-managed super funds, that flows for each generation. So for example, if a baby boomer is not in a self-managed super fund now, they're never going to go in one. You agree with that one? Unless they've sold their business. That'd be the only, and that's small. Gen X, I don't know what it is. How many Gen Xers are in this room? So I don't know what it is about you and SMSFs. It's just like there's the lost generation. So I don't know. It's like, anyway. But the next generation that's coming through, I'm finding that, you know, they've got 150, 200, 300. Some people say, how much should I have in order to set up a self-managed superannuation fund? You know, for me, probably around about 60, if you're like 30 or 40, $60,000 or $80,000. And what do I say that? Because I sort of talked about it. What do I say that? So if I'm in an industry or retail fund, I said that about Robbo before, is if I'm in an industry or retail fund, I'm giving money to a whole lot of faceless people. Would you agree with that one? The first thing they do is when I put a contribution in, they take 15% out. Why would they do that? There's no such thing as contributions tax. So they're ripping me off by 15%. The second one is they actually, when they determine your unit entitlement, guess what they're doing on the same thing? They actually have in their accounts, because I know I used to do it at KPMG, they have a capital gains tax provision. So they're actually determining that there's a capital gain built in. So your underlying value in that superannuation fund is not what it really should be. Inside a self-managed super fund, the money goes in, you get a tax deduction for it, so that's great. Your business gets a tax deduction, your family trust gets a tax deduction. Now, what's the limit on the tax deduction? So when we look at the Tax Act, there is no limit. I could put in $1 million if I wanted to. I could put in $2 million and get a large tax deduction. There's different tax consequences, and that's one of the areas you need to get over on top of. And when we release that, you know, the SMSF one, you're really going to get on top of it. Now, importantly, from that perspective, once you put the tax deduction in, obviously it's assessable income of the fund. Has everyone got that one? So none of this contributions tax rubbish. So it means you will pay tax on that when you lodge your return. Is everyone with me on that one? So when we lodge a return, that's when we're going to pay the tax. Now here's the thing, between now, if you put in a contribution between now and 30 June, your job is to maximise the tax deductions. So here's first thing, why would you negatively gear outside of super when it's better to negatively gear inside of super? So everyone follow me on that one? Because the problem is outside of super, and I see it each and every day, you know, my family wealth, like, I've got 5 or 6 investment properties I'm going to go, and they're all tax positive. So you know, if they keep those properties for the next 15 or 20 years, guess how much tax they're going to pay? A fortune. If it was in a self-managed super fund, how much tax are they going to pay? 0. Which would you prefer? Do you mean you're getting a better return because you're not paying any tax? So again, you think about the concept of negative gearing, which is I'm going to get a negative, I'm getting interest expense. But isn't it better to use your tax-deductible salary, listen to that, tax-deductible salary as capital to outlay on a geared investment? Does everyone follow that one? So I'm getting a tax deduction to buy a property. So let's say I put in this year $200,000. $200,000 tax deduction. Everyone with me on that one? So I'm going to do $200,000 tax deduction. I then go out and get We Love Loans, and they're going to give me an $800,000 loan. So I've got $1 million property. Everyone with me on that? So then I'm going to pay, let's say, $70,000 in terms of, interest expense. Then I prepay that interest expense, so that now is a deduction. So virtually, what have I done? I have negatively geared, but that deduction, that interest expense, is going off against that salary that I've made. And then when it goes down the track, my goal is to build that up. I tell everyone that comes in here, particularly the younger crew, I always say you and your spouse need to get to $2 million each by the age of 60. And if you've done that, is it going to be happy days for the rest of their lives? Absolutely, it's going to be happy days. So again, if we go over excess, now the problem about that is PAYG, you're normally paying tax on the way through. If you go over, then what happens is an add back. So to the extent that I go over, if I've got 200, I'm over 170. So then what happens is that needs to be added back to my income, because let's say the $200,000 was a full salary sacrifice. So I've got plenty of money, don't need it. So I've done the full 200. So what happens is that 170 is going to be added back, and then we're going to determine what the marginal tax rate is. So you're going to get an amended assessment. Everyone with me on that one? So we're going to get an amended assessment, but because they don't assume that you've got negative gearing in that, they assume you've paid 15% tax. So you then get a 15% tax offset on that $170,000. So there's no way, even at your top marginal rate, you're never going to pay 45. It's always 15% less. Is everyone with me on that one? So, but I'm not going to have to pay that until you lodge your super fund's tax return and my tax return. So if I'm doing it for this year, ending 30 June 2025, I'm not going to have to even pay this until May or March 2026. So I've got a tax deferral and so it's a tax difference, so it's a deferred difference and potentially obviously a future income tax benefit. Now the other one there is, if I'm over 170 excess, it also means, let's say I'm 35. So what I'm doing, I call this the washing machine, because the money's in there, you're going, oh my God, clients, and if you get them in, I can't get access to it. Do you know when you lodge your assessment with the super fund, the tax office come back, you don't have to do anything, the tax office come back and say, this is my amended assessment, so you just check it and all that sort of stuff. You have to pay blah. They can get the money out of the super fund, they can pay it originally, but you've got 60 days, remember 170, you've got 60 days if you want to withdraw 85% of that money. Now get that in your head. Does everyone understand what I'm just saying? That money that's excess is not preserved money. It is not preserved money until that 60-day period goes in. So I can put the money in, get a large deduction, shift out my tax point, and then effectively, if I want, I can pull 85%. How do they get 85%? Because they assume 15% contributions tax. How dumb are they? Do you mean, does everyone follow that one? Now, it's a loophole, but it's like everything, loopholes at some stage. Now, it didn't work before because there was a penalty tax on it. But thank you, Pauline Hanson. In fact, she probably wouldn't be a bad Prime Minister at this stage. But thank you, Pauline Hanson. She got rid of that penalty tax. So there's no tax penalties at it. So how many of you would prefer to defer your tax like 12 months to 18 months? I mean, look at that. It's a PAYG bonanza, and it's great for doctors as well. So have a look at that one. Okay, so going back to that, I would say you can do this annually. The only thing is that excess concessional is also non-concessional. So you just have to watch out for your caps on the way through there. Next one, segregating. So this is a little bit sophisticated because a lot of you got clients who are both in pension and also accumulation phase, and they're old. Has everyone got those sort of clients? So here's what we do. What we can do is, it doesn't work for, if you're already over your pension transfer balance or your general super balance, you can't segregate assets for tax purposes. But I can always segregate under the SIS Act, provided, of course, your trust deed allows. So, for example, consider this. Remember the son and the dad and all that? So I'm going to give you, this is a good little strategy. Remember? Lent money, crypto, all that sort of stuff. Kid's got crypto and it's about to go ballistic. So he's got the old, what is it, the fart coin or something like that. So it's about to go ballistic, but it's currently worth $100,000. What can he do? What would you do? Now this is super sophisticated. What would you do? Yeah, transfer $100,000 of cashola or shares or whatever from dad's account and put this over there. Crypto goes up, dad's happy because he's already had his pension transfer balance. Because if it goes up afterwards, does it impact the pension transfer balance? No, not at all, because once it's in there, it's in there. So he's not starting an extra pension, he's just simply pumping it up. And the beautiful thing about the son is what? Crypto's gone up, what happens? Dad can pull it out. How much tax? Nothing. Would the son be happy with that? Absolutely. So again, these are the very sophisticated ones where I can tell you AI is not going to get around to that, but these are the little ones where you can make a really big difference to your clients. The one I really like is the SMSF will with the Death Benefits Trust. When I first, this is available on Lightyear docs. In fact, the Segregated Capital Growth, that's also available on Lightyear docs. It's called Separate Investment Strategies. Everything I'm talking about is available. You just don't know it yet. So it's always been there. So this one, when we have a look here, you can build an SMSF will, which allows you to do like 5 or 6 things, but you add a death benefits trust, which again is like one of these. It's got the bloodline, you know, all of that stuff that we talked about before, succession, blah, blah, blah. And then what will happen is, as long as you've got a dependent, whether it's a child or a spouse or a financial dependent, you can pay directly down from the superannuation fund to their to themselves. But what we want is, we don't want them to be able to take it directly. They can only have it if it goes into a SMSF death benefits trust. Does everyone follow that one? Because by putting it in there, it's going to be protected against a family law action, it's going to be protected against litigation, and more importantly, with the exception of New South Wales, by putting it there, it is not going to be caught up in a family provision claim. Whereas you'll all see, as soon as you see wills where superannuation's going over to the estate, you know the lawyer has got absolutely no idea about family wealth protection. So that's available up there. We charge, like for example, an LBO around about $2,500 for that, but I think that's pretty undercharged. I'd love to see what Rod Peters would charge with that. Okay, upgrade all discretionary trusts to leading member discretionary trusts. Again, so there's a couple of ways of upgrading. You can do it yourself. The only thing is, you're getting really close to that, you know, providing legal services. For the SMSF trustee, it's easy. You get the clause and do that. But once you start getting here, you know, quite often you'll have a look at an amendment clause, particularly if it's old. You've got to do this, you've got to do that, or whatever. Either you can get us to do it at LBO or LY Legal. I'd be charging for that. The next level that you have to think of, and we'll go down for it, is we want to start looking at splitting. So we talked about, let me go up forward. Okay, so when we go down, we started talking about yesterday the concept of splitting. So when we have our trust here, whether it's our family protection trust or your existing discretionary trust, the areas we want to do is get a really good line of succession. Who's first, who's second, who's third? Now, all of you have got kids under age 18. You can have your kids as appointors. It's the same as if, Wills and Charles die. Harry's going to, Wills, George, what's his name? Is it George? George is going to be the next king, but he's going to have advisors. That's where your guardians come in. So you need to create that line of succession. That's why we did succession, asset protection, estate planning advisors. So we want to have that really good, strong line of succession. But, and this is the most important one, when someone dies, the best vehicle to have, essentially, is going to be the trust or the self-managed super fund. You see, it doesn't matter what state you're in, you can't take money out of the estate for a certain period of time. You've got to wait for probate, and even then, in Queensland, you can't take any money out for 6 months. If you do so, the executor may end up being personally liable if there's a large family provision claim. So wills are by their very nature cumbersome, and they're not the place that you want to be. Self-managed super fund, if someone dies, when can you take money out? As soon as you get that death certificate. So that's the place you're going to pay your funeral expenses from. Does everyone follow that? Just pay your funeral expenses straight away. A reversionary pension where it goes straight on to the spouse is great, because if a spouse dies, the next month the pension goes where? To the surviving spouse. There's no cash interruption at all. It automatically goes to them. When it's in a trust, it goes down to the next generation if mum and dad die. So if there's mum and dad or partners, the last surviving person will actually be, it's not a bad one for this one. I'm jumping ahead, but that's okay. When I have a look here, so the next person in is going to be the surviving spouse. Why is that important to be in that trust? Well, for example, if we've got an asset, and I'm going to go here, and we talked about the Cowart case yesterday, the problem with joint assets, which are 99% of most assets for couples in Australia, are the remaining surviving couple is exposed. Has everyone got me on that one? Because if I've got a property that's been left to me, if they go out and have another relationship, how long do they have to be in another relationship before it becomes matrimonial property? 2 years. Does that follow? And then if they leave, bang, I can tell you there's a good story in the book. My daughter's best friend, 26, lovely, grandmother gave her a $2 million townhouse in Brighton. Wouldn't you love that? Wouldn't that be fantastic? Boyfriend she'd been living with for 4 years, up and left, family lawyer, had to sell the house. He got 900, the lawyer got 100. He's overseas, Instagramming all the birds he's with over in Europe at the moment. So she lost the boy. She also ended up losing the house. And the easier way would have been to, the grandmother put the money into a family protection trust and then what? Lent it to the granddaughter interest-free. Does everyone follow that one? And then you take a registered mortgage over it. And here's another one. If you've got kids, never give them money. Always, because when it comes down to family law, you look at the balance sheet. What do you want to see on the balance sheet? Liabilities. You don't want to see assets. Does everyone follow that one? So every time you record, if you give the kids something, just put it through, either get a loan agreement that you can get straight off from Lightyear docs, and every time you give them money through the internet, just record it. Tiana, loan agreement. Sophia, loan agreement. Because it doesn't matter, it doesn't mean you're ever going to call it. It just means that effectively you've got it on balance. Now here's another strategy. I'm going to have to wind up anyway, but anyway. So joint assets. Another one I'm finding is I'm seeing these really large self-managed superannuation funds. They've got both a large amount in accumulation and also pension. And what's happening there, that's dangerous, because if there's one person left and they die, what have we got? We've got a shithole, haven't we? Because you imagine, I dealt with someone who had $5 million potential in taxable component, multiply by 17%, you're looking around about $650,000 of tax if they don't do anything. So what should they be doing? That accumulation stage is sitting there doing nothing. How can they look after the family with it? We can't, because the SIS Act won't let us do it. Has everyone got that one? So what we want to do, we pull it out tax-free. So I've just saved $650. I put it into an FBT, Family Protection Trust, and remember, this money is going to go to them anyway when both parents pass, because they've got their own little sub-trust sitting in here. That money's going in, and then what do you think the parents can do? They can lend the money out interest-free, so they can look after their family or their grandchildren right now. Because at the moment, it's sitting in an environment that is really an estate planning environment, but it's one that is actually laden with death benefit taxes. And it's the only place in Australia where you have death taxes, and that's in there. So we've got to be very careful. So what we want to try and do, and I'll probably just wrap up now because I'm running out of time, but what we want to do is really start to build these Buckingham Palaces that, again, with the protector, putting all the equity over there, as I said before, building in those split trusts for each child. In the same way we talked about all the appointors going down here, what we do is we effectively have each one is the appointor of their own sub-trust, so that there's no fights, there's nothing. Blended families, it's a little bit difficult. You could throw them all into one FBT, but the better one, and I know we did that with Dana and her crew and Brett, end up having two FBTs, one for one family, one for the other. And then the question was, well, how the hell do we equalise? Well, what we do is we actually do the gift, and one gift goes to so much and one goes to another, so they're both equalised. And on death, it all gets out. And if our estate has nothing in it, what are the chances of a no-win, no-fee lawyer taking that on? Whereas I can guarantee, if you've got a blended family, I can absolutely guarantee that estate is going to be challenged. Because all you have to do is show that you're a stepchild or a child, and of course you're going to have a crack at your step-parents or anyone's will. The only other thing I've got there, I've got the waterfall will. I think I'll just finish off this one. Child Maintenance Trust, I'm not going to say much. If you have a client who's got a business and is currently paying child support or ends up with child support, I will show you how to make that child support tax deductible rather than coming from after-tax money. And it's all I picked up from a ruling. All the stuff that I usually do, the best strategist in the world is the tax office. And if you've got tax rulings for everything, I'm pretty happy with that. It's funny, sometimes I'll say, and people say, yeah, you can't do that. I say, but I've got a ruling. Oh, no, that's wrong. I say, well, don't do it or object to the commissioner. I don't care. So anyway, do you want to do a couple of questions? But we'll be coming back a little bit later on because I'm just conscious of time.